Hello and welcome. My name is Elliot Gu. I'm Chief Analyst for the Deep Dive Investing Service as well as Pig vs. Bear. And today, in this video, I want to answer one of the most common questions Roger and I receive from readers, and that has to do with different orders that you can use to buy or sell a stock. And specifically what I'm talking about is a market order, a limit order, a stop order, sometimes called a stop loss order, and also terms like good until canceled and day order. Kind of the basics of putting a trade in with your broker, but some of these order types can be really useful, not just for traders as well, but also for investors to help you get into stocks at more advantageous prices and exit stocks at advantageous prices. And in this video today, I'm going to kind of show you the basics of all these different order types, define what they mean, some basics about how you can use them, and in a couple days I'm going to send you another video, part 2 of this if you will, where I'm going to actually run through some specific examples of investments we've recommended in the Deep Dive Investing Service. These are stocks we've recommended in Deep Dive, and how we've used orders like limit orders and stop orders to squeeze additional returns out of these stocks. In some cases, adding 4 or 5 percentage points to our returns from one of our more profitable themes in regional banks. So I'm going to tell you a little bit more about that in a couple of days, but today I'm going to have a little presentation as well to show you the basics of these different orders you can leave with your brokers. First up is a market order. A market order is probably the simplest order out there. It is an order that basically tells your broker, just buy the stock for me at the prevailing price. So let's say you want to buy 100 shares of a stock. In this case, let's say Citigroup, because that's the example I have on your screen. You want to buy 100 shares. You go onto your brokerage site, you log in, you put in 100 shares, you put in the symbol for Citigroup, which is C, and the first option there is probably market order. And what that says is go out and buy 100 shares of the stock at whatever the prevailing market price is. So in this case, what you're going to get is you're going to get that stock at the offer price or the ask price. And what you see on this first slide is actually the bid-ask spread for Citigroup on August 14th, but it doesn't really matter. It works like this every single day of the year. And I'll circle it here. And that first line you see there, at that particular time, which looks like it was 2:23 in the afternoon, the bid price for Citigroup on the New York Stock Exchange was $70.06. The ask or offer price was $70.07. Now what that means is that if you wanted to sell 100 shares of Citigroup, your broker is going to give you the bid price, the lower price, $70.06. If you want to buy 100 shares of Citigroup, your broker is going to give you the higher price, the ask or offer price, which is $70.07. That spread, that 1 cent spread, is part of the profit that the market maker makes by buying and selling and trading in this security. Now, as you can see here, this is a big S&P 500 company, one of the largest companies in the stock market, one of the largest banks in the world, in fact, and it's very liquidly traded. On this day in question, over 8 million shares had changed hands by before 2:30 in the afternoon. Therefore, it's considered very liquid, and the bid-ask spread tends to be very tight. In this case, only 1 cent. But if you put in a market order, you are going to get the prevailing price, which is most always going to be the offer price if you're buying or the bid price if you're selling. Not all stocks, unfortunately, are as liquid as Citigroup. Here's another example. This is a stock that we have recommended in Energy and Income Advisor, one of our longer-term services. It's a master limited partnership called Delek Logistics Partners. The symbol here is DKL. This is the same day, August 14th, 2:26, so just a couple minutes later, and this is the same exact screen I showed you for Citigroup. However, in this case, and let me go ahead and circle that again to make it clear, in this case, the bid-ask spread has been much wider at times. For example, at the current second, the bid price is $31.60 and the ask price is $31.75. That's a 15-cent bid-ask spread. Now with Citigroup, if you really want to get into the stock, going ahead and putting a market order in a normal market probably isn't a terrible thing. You're going to get that offer price, but it's a pretty tight bid-ask spread, so it's pretty much where the stock is trading. In a stock like Delek, though, when there were only 66,000 shares trading hands as of the time I took this screenshot, you're looking at a much wider bid-ask spread of 15 cents. I've actually seen this stock have a bid-ask spread closer to 50 cents, which means you could look at the last trade in Delek and see it at 31, and then you put in a market order in with your broker, and suddenly you're buying at 31.50. In fast-moving markets in particular, you might see that Citigroup spread widen out 2, 3, 4, 5 cents, but you might see this Delek Logistics Partners spread widen out to 25, 50, even 75 cents in a very fast-moving market. So you have to be particularly careful when using market orders, particularly in less liquid securities like Delek. This is even more true if you happen to be among those who trade options, either buying and selling options or using strategies like covered calls and the sale of puts to earn income on stocks. And let me flip here to this next slide here. This is an options chain for Ingersoll Rand, which is a big industrial company that we have recommended in the past in deep dive investing. And you got the call options on the left and you've got the put options on the right. So let's just look at a random one of these. And you'll see here that, for example, at this time Ingersoll Rand trading around $97.20. And so the 97.50s are pretty much at the money options. Let's say you wanted to buy a call option on Ingersoll Rand because you think it's going higher in price and you just want to speculate on it. Well, here is the September call option for Ingersoll Rand. And what you can see here is that the bid price for that option is $1.80. The ask price is $1.95. So that's a 15-cent spread on something that's trading at $1.80. That's a very, very wide, in percentage terms, spread relative to either Citigroup or Delek, of course. And what that effectively means, for example, is let's say you wanted to buy one contract, one call option contract. The bid price would be $180. The ask price is $195 because each options contract is actually 100 options. So that's actually a $15 spread between the bid and the ask. What I would typically recommend if you want to buy or sell an option in a normal market is to try to get somewhere in between the bid and ask spread. I'll usually go out and use a limit order, and I'll tell you exactly what that means in a minute. And I'll set that limit order somewhere in between 180 and 195. Maybe set it at 190 and see if you get filled at that price if you're selling the option, or maybe you set it at 190 if you want to buy the option. Whereas if you put a market order in, you're going to pay that full $195 per option. Doesn't sound like a lot of money, but let's say you're trading 10 options. Suddenly that 15-cent spread becomes $150 on 10 options contracts. That adds up, even if you're trading in fairly large size. So if we move, and typically, in summation, market orders are a no-no for options. So what's a limit order? A limit order is actually one of my favorite order types. In deep dive investing, we use limit orders to execute what we call our dream buy strategy. You may have also heard Roger and I talk about the dream buy strategy in Energy and Income Advisor and also in Conrad's Utility Investor. And we often recommend the use of what's called a good until canceled limit order to execute that strategy. In Pig versus Bear, not only do we use it to enter trade recommendations, but we also often use limit orders to exit profitable trades at pre-designated sale points. So it's a very useful order type, and let me explain what it is. What a limit order does is it's an order that you leave with your broker to sell a stock or buy a stock at a particular price or better. So let's say that you want to buy a stock, Citigroup, that's trading at $70 a share, but you don't want to buy it at $70 a share. You want to buy it at 68 bucks a share. You could go out and put a limit order with your broker at $68, and your broker will execute that buy if and when Citigroup were to dip down to $68. So they're not going to execute it at 70 or if Citigroup goes up to 75, only if it gets down to $68. So you're basically guaranteeing yourself a price or better. So in other words, let's say tomorrow morning Citigroup gaps down at the open and opens up at 67.50. Your broker is going to execute your trade around 67.50 because that's a better price to buy it than 68. On the other side, if you're looking to sell a stock, again, let's take in this case Comerica, which is what this slide is of. Symbol there is CMA. Comerica is a regional bank I'll talk a little bit more about in our second part to this video series. Right now, Comerica is trading around $97.60. Let's say that you decide that you want to take profits on this trade, on this investment, something we recommended in deep dive investing at much lower prices in March of 2017. Let's say you want to take profits on it at 100. You could set a limit sell order at $100 a share on Comerica, and your broker will only execute that order if they're able to execute it at a price of $100 or higher. So you're guaranteeing a price, but you're not guaranteeing that you're going to get executed. With a market order, you're going to get executed. Your broker's going to take the best available price. With a limit order, they're only going to execute your order if they can get a price better than what you set as a limit order. So you've probably heard the term stop order. Oftentimes they're called stop loss orders. And you'll hear some people say that you should set a stop on every single trade or investment that you take on. What is a stop order? How do we use them? And what are they used for? And so on this slide, I've actually put up a chart of New York Community Bancorp, which is, by the way, a bank that we have recommended as a sell in deep dive investing. It is not a stock we like. I'm using it for illustrative purposes. Symbol there is NYCB. Reason we don't like it's a little bit complicated, but it has to do with the type of loan that they have in their books. It is, however, a very widely recommended bank. It's a bank I've seen recommended on TV, on the internet, on countless publications, and it was recommended particularly heavily late last year. I think one of the main reasons is because it has a very high dividend yield. Unfortunately, I'm not sure that dividend yield is sustainable over the long haul. So what you see here, let's say though that you did buy or you owned New York Community Bancorp, and you owned it back in November. Back then it was trading as low as $12.50 a share. And as you can see in this uptrend that I've kind of circled in red, the stock did trend higher into early 2018, kind of dragged higher with the rest of the regional banking industry. So let's say that you own the stock from $12.50. It got up to around $14.50 in roughly, let's just call it February, March of this year. And you said, okay, I like the stock. I think there could be more upside, but I want to get out of this name if it trades below $13 a share. In other words, I don't want to give back up all my profit. What you could do is set a stop order or a stop loss order. And essentially what this is a combination of a stop order and a market order. It's really a stop market order technically. And what happens is, let's say you set that stop order with your broker at a price of $13 a share. What that means is that if New York Community Bancorp trades down and touches $13 or trades below $13, that stop order will automatically convert into a market order to sell the stock at the prevailing market price. And you can see what happened in this case is that New York Community Bancorp by late March did trade down and touch 13 and then traded below 13. So when that happened, what would have happened is your broker would have sold the stock at the prevailing market price. In this case, that turned out to be a very good thing. As you can see this arrow I've drawn here, the stock continued to track lower until hitting a low down here around $10.40 in the summer. So you would have given up your gains if you bought it late last year and then some on the stock. So this is an example of a stop order protecting you from a stock declining too far below a certain price. The danger of a stop order, a traditional stop order, as I said, is a stop market order. Now in a fast-moving market, it has the same problem as a regular market order does, which is that a stock can trade through that stop and then the next available price can be way lower than you expected. Let me give you an example here. This is Johnson & Johnson, symbol J&J. I picked it basically because it's a blue chip company that everybody knows. And this is back in 2015. So you look here, this area that I've circled in red. Johnson & Johnson, through most of 2015, was trading around $100 a share. A little over, a little under 100. Let's say you owned Johnson & Johnson and you said, you know what? I like the name, but I don't want to own it if it drops below $95 a share. So you might say, okay, if it drops below, let's say $90 a share. So you might say, okay, I like the stock, but I don't want to own it if it drops below $90 a share. And I've kind of drawn that in red there. So I'm going to set a stop at $90 a share to sell Johnson & Johnson if it trades below that level. So it wouldn't have touched that stop order for a long time through 2015, but come late August of 2015, we had a flash crash. Now, on that flash crash day, the Dow traded down over 1,000 points in literally minutes, and stocks became very thin. The bid-ask spread on all sorts of stocks, even blue chips like Johnson & Johnson, widened out in some cases to more than $1, sometimes several dollars per share. So very wide bid-ask spreads. Now, what would have happened on that day is the stock did trade down to $90, but when it was trading through 90, it was moving very, very, very fast. So what happened to a lot of people who set stops is their stops got triggered, but then it became a market order and the next available price was 85 or 83. So what literally can happen, and I've heard horror stories like this before from readers, they set a stop on a stock that they own, and they were away from their desk. Maybe they were at the grocery store, out playing golf or something, and they came home, checked the market, and they realized that the market traded about where it traded a little bit lower, a little bit higher, but intraday there was this big dip. And they noticed that they actually get sold out of a holding like Johnson & Johnson at a very bad price because they got stopped out at exactly the most inopportune time. And that sounds like an extreme event, right? What happened in 2015? But not really. Earlier this year, in February, we had the Dow lose over 700 points in 8 minutes and then recovered all of those losses and then some in the next half hour. So setting stops can be dangerous. It's particularly dangerous on illiquid names like some of the MLPs, where Roger and I typically do not recommend stops. It can be a useful order. We do use it particularly in our trading product, Pig versus Bear. But we don't agree with the idea that you should set stops on all of your holdings. We prefer to watch our holdings closely, and if we see a reason to sell, either because it starts to break down or some fundamental change, we recommend selling. We do use stops, but we disagree with the advice to use them on every stock you own. It's also possible to use the stop in another way, to get into a stock. And we typically do this when we want to buy momentum. So what do I mean by that? Well, there are 3 things I look for, particularly in deep dive investing, in prospective investments. There's valuation. Is the company cheap or expensive? There's quality. Is it a steadily profitable company? Is it the best of the best within its industry, best of breed? Or is it a laggard? And the third thing is momentum. Is the stock trading higher? Because what you'll find is you might find a company, I've certainly had this happen to me many times, I find a company, I like the fundamentals, I like the management team, I think it's a high quality company, best of breed in its industry. The stock is going down. You can certainly buy some of that stock because you feel like you understand the fundamentals and you think it's going to turn around, the market will eventually recognize your view. But what I often like to do is buy a little bit of that company, sort of dip my toe in the water, if you will, and then add to that position when the market starts to confirm my view by showing some momentum. In other words, some upside momentum in the stock if I'm buying it. I know the word momentum is often associated with trading, not investing. I found it to be very useful in investing as well. Here's a situation where we used it in deep dive. This is a company called United Rentals. We first recommended it back in May of 2017. Price was around $105, $106 a share. But it was trading, it was kind of in a downtrend at the time. We liked the story, we liked the valuation, we thought the market had been too harsh on the company after their first quarter earnings results, but we felt that, but the stock was in a downtrend, the market wasn't yet recognizing our view. So what we recommended is setting a stop buy order at a higher price, up around $112, $113 a share. The idea being that when United Rentals started to bottom out and trade higher, when momentum turned positive, we would add to our position so we could benefit from that. If we turned out to be wrong about the stock and it continued to slide, we could have gotten out, and because we kept our initial position small, it wouldn't have hurt our overall return so much. So what you see here, though, is that by July, we got executed on the second part of that position, the second half of that position, and as I show you with this big red arrow, the stock ran all the way up to over $180 a share by early 2018. So buying that momentum was an excellent timing mechanism for getting more shares of United Rentals. We used a buy stop order. In other words, as soon as United Rentals traded to and above 112, the broker automatically bought more shares of it. Automatically, without you having to sit in front of your computer screen or set an alert on your screen or whatever. So very useful in some cases to use stop buy orders. There are a number of other order types out there, kind of less common. Let me talk about a few of them. First of all, I told you that most stop orders are really stop market orders. Once the stop price is touched, it converts to a market order. It's also possible to set a stop limit order, which is a combination of a stop order and a limit order. So basically what happens, let's say you own a stock that's trading at $100 a share. You set a stop at 95 and you set the limit on that stop at 94. Your broker will, as soon as it trades to 95, your broker will automatically set a limit order to sell the stock at 94. So in a fast-moving market where the broker can't sell it at 94 or 93 or 92, you won't be executed on that. Your broker will wait until the stock recovers back above that $94 area. Can be useful, for example, during the flash crash, having a stop limit order at least wouldn't have had you selling out of Johnson & Johnson at the lows around $82. Day versus good till canceled, kind of self-evident. A day order is good for one trading day. A good till canceled order is good until you cancel it. We tend to use GTC or good till canceled orders. For example, in our Dream Buy strategy in Deep Dive, or Conrad's Utility Investor or Energy and Income Advisor, where we set a price, a limit order, where we want to buy a stock, and we make it a good till canceled order. That way, you don't have to be watching the market. When it touches that price, your broker will automatically get you in at that price that we've already thought through and already designated as being a good entry point. Trailing stops, some brokers offer this. One example, you buy a stock at 10, you set a stop at 9, $1 below the closing price of the stock, and instead of it staying at 9, instead of your stop order staying at 9, regardless of what the stock does, your broker raises the stop to $1 under the highest closing price of the stock that you own. So in other words, let's say the stock closes a couple weeks later at 12, your new stop would actually be 11. Some people use trailing stops. We don't tend to. They can be useful. We find it more useful, though, just to reevaluate your stops periodically and adjust where needed. Buy to open, buy to close, sell to open, sell to close. These are options trading terms. I know many of you don't trade options, but if you do, let's say you want to buy a call option that you don't already own, then you're buying to open. So you're buying that to open the trade. If you already own a call option and you want to sell it, you're selling that option to close the trade, sell to close. Sell to open would be, let's say that you wanted to sell a call, a covered call against a stock that you own. You don't already own that call, you're selling it. That would be selling the call to open the trade. If you wanted to buy back an option that you were short, that you'd sold, you could buy to close. Those are what those terms mean. The final one is selling short. Selling short. Basically, it's a way of betting on a decline in a stock. Betting that a stock is going to fall in value. The idea is that you sell the stock at a higher price and look to buy it back at a lower price at a later time. This is a separate order type than selling because of the way shorts are executed. You're actually borrowing shares from another investor to execute this trade. We do use sell short as a technique in Pig versus Bear, our trading service. We have used it in deep dive investing, and I think we'll probably do more of that when the U.S. stock market enters a bear market again, which we haven't seen since 2009. So that's the basics of what I had to tell you today about the major order types out there. Market orders, limit orders, stop orders, buy limit, stop limit orders, good till canceled orders, day orders. As I said, watch your inbox because in just a couple of days I'm going to send you another video where I'm going to go through some specific examples of how we've used these various order types in deep dive investing to squeeze additional profits from our recommendations. In some cases, it can make a huge difference, 5% or more from a group of stocks over a period of a little bit more than a year of additional gains just by using these orders to strategically enter and exit recommendations, not just for traders. So keep your eyes open for that. I hope you enjoyed this. I hope you found it useful. My name's Elliot Gu. Thanks again for listening.